The Bangko Sentral na Pilipinas raises borrowing costs by 1/4 point, and this brings the key interest rate to 6.25%, the highest since November 2008, effective tomorrow. Bangko Sentral Chief Felipe Medalla said further monetary policy action was needed to address price pressures despite inflation slightly easing to 8.6% last month. Joining us now is Shan Saeed, Chief Economist at Juwai, IQI, joining us right now in Kuala Lumpur. Shan, thank you so much for joining us. So do you think that this 1/4 point rate hike by the Philippine Central Bank will be the last one? And could it really stifle rising inflation in the country?
I think, in my opinion, it was a sagacious call to raise 25 basis points. It clearly indicates the central bank is confident that inflation will come down. And we have shared many times that inflation in ASEAN or in emerging economies, it will remain in single digit, but in advanced economies, it will remain in double digit. So I think it was a good call, but it clearly indicated that Bangko Sentral and Filipinas will maintain a status quo in the next round.
And Shan, the Philippines has had one of the best performing economies in 2022 with 7.6% growth. Do you think with interest rates now at 6.25% that growth can be sustained at these levels in the first quarter of this year?
I think we have already shared in our newsletter that we expect Philippines to achieve a growth rate between 4.5 and 5% despite global economic instability, despite financial fragilities globally. Philippines still is attracting investment. It is still having strong domestic demand. And above all, Bangko Sentral, the Filipinas, it has maintained structural stability in peso. The government has maintained macroeconomic stability in the country. That is vital for global investors. That's why you see most of those global investors, they are relocating their assets in ASEAN. And if you pick up Economist magazine last September, they mentioned about 3 regions that will be driving the growth of global economy. One is ASEAN, second is GCC, that is Gulf, and the third is Africa. So we at Juwai IQA, we feel quite buoyant on ASEAN economies, and we feel that these economies will perform much better as compared to Europe, North America, Japan, and UK.
All right, let's take a look now at the U.S. Federal Reserve. It raised interest rates by 1/4 point. Do you think, Shan, this is the right time to raise the cost of borrowing despite fears that the move could add to a financial turmoil after a string of bank failures?
Very relevant question, Rico. The markets are getting fractured. Fed has over-tightened. They have gone beyond a certain limit. And every monetary policy has got certain limit. They have stretched to the limit. And this is not new to us because, as you know, I follow Milton Friedman. Whatever Milton Friedman predicted 33 years ago, how Fed is going to create crisis in the form of inflation, how Fed is going to panic. Right now, what we are saying with so many banks going down, Fed is panicking. They don't have any policy lever to instill confidence, to spur growth at the moment. So I think market will continue to stay in bedlam. They will continue to have bazooka. I don't see the market settling down. The markets are whistling past the graveyard. Investors are getting nervous. And most importantly, the global investors, they're having 2 minds. Whether Fed will be able to bring the inflation down to 2% that they are targeting, I doubt at this point of time because 2% inflation rate, it will not happen overnight. It will take some time. So Fed
Shan,
will be in a very tight situation, and they will be having the last interest rate hike on 3rd May, and after that they will take a pause, and then
Shan,
they will cut interest rate.
So Shan, I'd like to jump in here. Now, you talked about over-tightening, and the sharp increase in interest rates since last year has led, of course, to the strains in the banking system. 2 U.S. banks, Silicon Valley Bank and Signature Bank, collapsed this month, buckling in part due to problems caused by higher borrowing costs. What is your view? Could this lead to more failures in the U.S. banking system? And are you concerned this could lead to contagion effect like what we saw back in 2008?
Yes, Rico, I have personally seen how the markets collapsed in 2008. I was studying at University of Chicago. Lehman Brothers and Bear Stearns went down in front of my eyes. In 2008, 25 banks collapsed, and the total assets that went down was $379 billion. 2023, two banks have collapsed, $319 billion of assets have gone. And right now, investors are nervous. Even today, there's one bank called Pac West, 20% of total deposits have been withdrawn. So those community banks, those small banks, they're having tough time because depositors, they don't have confidence. And this contagion will go further. We have seen what happened to Credit Suisse. If the Swiss National Bank have not bailed out Credit Suisse, Credit Suisse would have been gone. Nobody was willing to bail out Credit Suisse. So I think depositors in US, in North America, they are quite nervous. 186 banks have requested FDIC for insurance for the next 2 years. If they are not insured, those banks are gone with the wind. So the situation is very, very tight in US banking system at this point of time.
Thank you so much for your insights, Shan, Saeed, Juwai, IQI Global Chief Economist, joining us from Kuala Lumpur.